Great to talk to you today. I want to start with your picks. We'll start on a positive note here. American Express, one that you're really liking. You say it's all about return on equity. Walk me through your thesis.
Right. So, I mean, this is as we all know, a wonderful brand, top performing management, and a company in the financials industry that's come into the year projecting over 15% top line growth. And that's in spite of potentially challenging economics in the back half of the year. And that's being driven by the strength of their clients, which is millennials, small businesses, and a return to travel, which is a big part of their business as well. So we see good opportunity for them this year, good visibility, a company hitting on all cylinders, and resilient against what could be a little bit more challenging economy going forward.
Mac, if we do see a recession, though, are they still going to be able to maybe they'll be able to weather it better than some of their peers out there? But I guess how does that then position that company given the pullback that we could see?
Right. So I don't think they're immune to any kind of economic malaise. I mean, they would certainly see billings decline. But if you look at when they came out of the pandemic, they have they're very smart about their business model. They adjusted it for the cost and they ramped up spending in the back half. And they position them for growth going forward. So first, I would say they have a resilient customer base, as I mentioned before. Number two, they can adjust their business accordingly in terms of costs and so on. And three, they understand these cycles and have shown an ability to manage through them.
Another name that you're liking, Interactive Brokers here. You point specifically to the steadiness, the steady growth that you have seen there in such a choppy environment. What else do you like in that name?
So, I mean, this is a history of very successful execution over a number of years. You have a founder, Thomas Petterfy, who's just done a tremendous job building shareholder value here. And in my opinion, it's in the secular growth. They have 2 million accounts. It's a global business mode in discount brokerage. So well respected for their capabilities globally. A very significant TAM against that. Growing accounts at 20% plus. They had 2 major wins in terms of the international white labeling space, which will have an acceleration in the metrics, which we saw in the last month. They're well capitalized at $12 billion, so plenty of capital to continue that growth. And then you have margins at 70%. So, retain a lot of capital and just drive a nice business.
Mac, let's get to some of the plays that you're saying that people should avoid right now. One of those picks is PacWest, obviously a name that's been caught up in the volatility that we've seen in the regional banks. Why don't you think the worst is behind them yet?
Well, I just highlight PacWest, but it's really kind of a bellwether for some of the smaller and regional banks. And I think those will be more challenged in general. We've seen the inverted yield curve. We've seen the rise in deposit costs. I mean, the deposit costs there was 290 versus 13 basis points a year ago in the first quarter. So it's pretty dramatic, impact of their cost of funding. And we're seeing that across the space. You have higher regulations coming forward, and you also have, kind of the other impacts as well. So, the ROEs could be challenged and the visibility is going to be difficult. So I just think they're better places to put your money to work and with a little more visibility and a little less tough conditions.
What specifically are you expecting around regulation, and to what extent how significant do you anticipate the pullback to be as a result of it?
So, I mean, I think they're looking at a number of areas. I mean, specifically also the smaller banks who've typically not been as well regulated. So there'll probably be some more tests in terms of the stress and maintenance and understanding their balance sheet, et cetera. But also a big focus will be on HTM, as we know, because we've seen some embedded losses in a lot of these firms. And there are certain capital holes with them that they're trying to get out of as well. So I think there will be stricter regulations across several different areas of the businesses. All in all, will impact their, return on equity and their cost going forward. And that will kind of bring down expectations and impact the models.
Mac, another name that you're advising investors avoid is Coinbase, a stock that's actually done relatively well given the number of headwinds that's up against the stock right now, not to mention some of those regulatory concerns of those headwinds. What do you think the next couple months looks like for Coinbase?
Right. Again, not to pick on Coinbase, but it's just an area that we just don't focus on. We have an appreciation with what happened in the cryptocurrency space and their leadership there. They've obviously built a big business, 20 billion market cap. But the company is not profitable at this point, so kind of off the radar for us. And then, as we know, they've kind of in a fight with the regulatory authorities and how to regulate the business, to regulate those instruments. et cetera. So I think there's a lot of uncertainty there in terms of how the business will go going forward. And again, this is just not an area we focus on. We look for cash generative businesses, predictability, kind of the outcomes going forward in terms of regulations, et cetera. So that's why we're more attuned to businesses like American Express and Interactive Brokers.
Max Sykes, a portfolio manager at Gabelli Funds, with his picks and icks, as we like to call it. Thanks so much for joining us today.